Let's start with the very basics of market behavior. Understanding these fundamental principles is crucial, whether you're a seasoned investor or just beginning to explore the world of finance. We'll be demystifying the forces that drive market fluctuations, providing you with a solid foundation for making informed decisions. Markets go up, reflecting periods of growth, optimism, and increased investor confidence. This upward trajectory is often fueled by positive economic indicators, strong company earnings, and overall market sentiment. And markets go down, signaling times of uncertainty, correction, or even potential recession. These downturns can be triggered by various factors, including negative news, economic slowdowns, or shifts in investor sentiment. It's like ocean tides, a constant ebb and flow that shapes the landscape. The market's movements are similarly dynamic, influenced by a multitude of forces that create a continuous cycle of highs and lows. Sometimes high, representing peaks of activity and value, sometimes low, indicating periods of consolidation or decline. Understanding these cycles is key to navigating the market effectively. This is normal, and it happens everywhere, across global markets and various asset classes. Whether you're looking at Wall Street, Tokyo, or London, the principles of market fluctuation remain consistent. Stocks, with their inherent volatility, are subject to these market forces. Real estate, while generally more stable, also experiences cycles of appreciation and depreciation, and especially crypto, a relatively new and rapidly evolving asset class. But in crypto, these swings are bigger and faster, creating both opportunities and risks for investors. The high volatility is due to factors like market immaturity, regulatory uncertainty, and speculative trading. One day, you're on top of the world, celebrating significant gains and feeling like a financial genius. The next, not so much, as market corrections can quickly erase profits and leave investors feeling discouraged. Why do markets move? What are the underlying factors that cause these fluctuations? It's all about supply and demand, the fundamental economic principle that governs prices in any market. More buyers than sellers, prices rise, creating a bullish market environment. Increased demand drives prices upward as investors compete to acquire assets. More sellers, prices fall, leading to a bearish market characterized by declining values. Increased supply overwhelms demand, causing prices to drop as investors seek to offload their holdings. News, new tech, advancements and breakthroughs can significantly impact market sentiment and investor behavior. Government rules, even tweets from influential figures can trigger immediate market reactions. Policy announcements, regulatory changes, and even social media posts can influence investor confidence and trading activity. Can move prices, sometimes dramatically, highlighting the interconnectedness of information and market behavior. And don't forget human emotions. Fear, greed, and uncertainty play a significant role in market volatility. Change is constant. Expect it. The market is always evolving, adapting to new information and shifting dynamics. Don't be surprised when prices shift. It's a natural part of the market cycle. They always do, repeating patterns throughout history. The key is to be ready for these moves, to anticipate potential shifts and develop strategies to navigate them effectively. We'll break down how to handle them, providing you with the knowledge and tools you need to make informed decisions and manage risk, so you can not just survive the inevitable ups and downs of the market, protecting your capital and minimizing losses, but actually thrive, capitalizing on opportunities and achieving your financial goals. Let's get into it, and equip you with the skills and knowledge to confidently navigate the dynamic world of market fluctuations. You've heard the terms thrown around, haven't you? Cryptocurrency, blockchain, DeFi, NFTs. The list goes on. It can feel like a whole new language, especially when you're just starting to dip your toes into the world of digital assets. But don't worry, we're here to break it all down for you. We'll explore the key concepts, demystify the jargon, and help you understand what all the buzz is about. Bull market and bear market, what do they mean? These two terms are fundamental to understanding market trends, not just in crypto, but across all financial markets. They represent the prevailing sentiment and direction of prices, and recognizing them can significantly impact your investment strategy. Bull market prices are rising consistently and often dramatically. It's a period of economic prosperity, where investors are confident and eager to buy. Optimism is high. Everyone seems to be making money, and the fear of missing out, or FOMO, drives even more investment. Picture a bull thrusting its horns up. It's an aggressive, upward motion, symbolizing the relentless climb of prices. Bear market prices are falling. often sharply and unexpectedly. This is a period of economic downturn characterized by investor fear and uncertainty. Pessimism takes over. Investors start selling off their assets, fearing further losses, which in turn drives prices down even further. Imagine a bear swiping down. It's a forceful downward motion, representing the sharp decline in prices. These cycles don't follow a schedule, they can last months or years. Predicting the exact duration of a bull or bear market is notoriously difficult, even for seasoned analysts. In crypto, they move even faster than traditional markets. The volatility inherent in cryptocurrencies amplifies these cycles, making them more pronounced and often more unpredictable. Why the animal names? It's all about the direction of attack, up for bulls, down for bears. The imagery is simple but effective, providing a quick and memorable way to understand market direction. Knowing which market you're in helps you make smarter decisions and manage expectations. It allows you to adjust your investment strategy, whether it's buying low during a bear market or taking profits during a bull market. It's crucial to understand the cycle you're in. Recognizing these patterns can help you navigate the often turbulent waters of the crypto market and ultimately achieve your financial goals. Remember, knowledge is power, especially when it comes to investing. What's a crypto bull market like? Prices keep climbing, led by Bitcoin. Everyone feels like a genius. Your portfolio's all green. Social media buzzes with big wins and wild optimism. Friends who never invested before suddenly want in. FOMO, fear of missing out, takes over and people rush to buy. Many skip research, just chasing the hype. Altcoins and NFTs can skyrocket, sometimes with massive returns. It feels like a gold rush, and new investors flood in. But remember, hype doesn't last forever. Now the flip side, the bear market. Prices fall, optimism turns to fear, and charts bleed red. Panic spreads, people sell to cut losses. Social media gets quiet or negative, full of FUD, fear, uncertainty, doubt. Hype projects with no real value often collapse. The weak get weeded out, but strong projects with real tech and communities survive, and even get stronger. Bear markets are a stress test, revealing what's built to last. It's a time for building, not hype. Focus shifts to substance. Let's talk about emotions and your money. Greed hits in bull markets, you want more, so you buy high. Fear takes over in bear markets, you panic and sell low. Chasing pumps, you buy late, price crashes, and you're left holding the bag. Panic selling, you lock in losses just before the market recovers. Emotions make you buy high and sell low. You need a plan to fight this. Bitcoin's history is full of cycles, big bull runs, painful bear markets, then repeat. Understanding this pattern gives you perspective. Think of the huge runs in 2013, 2017, and 2020 to 2021. Each time, prices soared, then corrected. A key event, the Bitcoin halving, which cuts new supply every 4 years. Less new Bitcoin means potential for higher prices if demand stays strong. The last halving was in April 2024. It's not a guarantee, but it's a major factor in Bitcoin's design. Watch for it. Bear markets are tough, but you can survive and even grow. Rule 1. Never invest more than you can afford to lose. Protect your financial safety net. Do your own research. Don't just follow hype. Look for real value, strong teams, and active communities. Consider dollar cost averaging. Invest a set amount regularly, no matter the price. This takes the stress out of timing the market. Use bear markets to learn. Study, read, and build your knowledge. When the next bull run comes, you'll be ready. Bull market roaring? Here's how to make the most of it. Set clear financial goals. Know what you want to achieve. Have an exit strategy before you buy. Decide when you'll take profits. Don't let greed keep you in forever. New projects will pop up with lots of hype. Resist FOMO. Stick to what you've researched and understand. Don't chase every shiny new coin. Make a plan and stick to it. Your plan is your anchor when emotions run high. Discipline wins in a bull market. Bull and bear markets are natural cycles, an inherent part of any financial ecosystem. They represent the ebb and flow of investor sentiment, economic conditions, and market dynamics. Understanding these cycles is crucial for navigating the world of crypto. Recognizing where we are in the cycle can inform your investment decisions and help you avoid common pitfalls. Are we in a period of exuberance, or are we in a phase of consolidation and rebuilding? Knowing the answer can make all the difference. Crypto just moves faster. The volatility is amplified, the price swings are more dramatic, and the pace of change is relentless. This accelerated environment demands a heightened level of awareness and adaptability. What might take years to unfold in traditional markets can happen in months, weeks, or even days in the crypto space. This speed presents both opportunities and risks, requiring investors to be nimble and informed. Understanding this keeps you calm and focused. It allows you to detach from the short-term noise and maintain a long-term perspective. When the market is crashing, panic selling can be tempting, but a calm and focused mind can see opportunities where others see only fear. Similarly, when the market is booming, it's easy to get caught up in the hype, but a clear head can help you avoid overextending yourself. Cultivating this mental fortitude is essential for success in the volatile world of crypto. Success isn't luck, it's about strategy. It's about having a well-defined plan, understanding your risk tolerance, and making informed decisions based on research and analysis. A solid strategy provides a framework for navigating the complexities of the crypto market and helps you stay on track even when faced with unexpected challenges. It's not enough to simply buy and hold. You need to have a clear understanding of your goals, your investment horizon, and your exit strategy. Emotional control and playing the long game. Emotional control prevents impulsive decisions driven by fear or greed. Playing the long game means focusing on the long-term potential of crypto, rather than getting caught up in short-term fluctuations. It's about building a portfolio that can withstand market volatility and generate sustainable returns over time. This requires patience, discipline, and a willingness to ride out the inevitable ups and downs. Patience and planning are your best friends. They are the cornerstones of successful crypto investing. Patience allows you to weather the storms and avoid making rash decisions, while planning provides a roadmap for achieving your financial goals. Take the time to research different projects, understand the underlying technology, and assess the risks involved. Develop a comprehensive investment plan that aligns with your risk tolerance and financial objectives. Crypto is always evolving. The technology is constantly advancing, new projects are emerging, and the regulatory landscape is shifting. New tech, new ideas, new rules. Staying informed about these changes is crucial for making sound investment decisions and avoiding potential pitfalls. Keep learning, stay curious, and ask questions. Don't be afraid to challenge assumptions, seek out different perspectives, and delve deeper into the complexities of the crypto world. The more you know, the better your decisions. Knowledge is power in the world of crypto. The more you understand the technology, the market dynamics, and the regulatory environment, the better equipped you will be to make informed investment decisions. Don't just set and forget, stay engaged. Actively monitor your portfolio, track market trends, and stay informed about the latest developments in the crypto space. Focus on long-term growth, not daily swings. Don't get caught up in the short-term volatility of the market. Instead, focus on the long-term potential of crypto and build a portfolio that can generate sustainable returns over time. Invest in projects you believe in, manage risk, and be patient. Crypto investing involves inherent risks, so it's important to manage your risk exposure carefully. Diversify your portfolio, set stop-loss orders, and never invest more than you can afford to lose. It's a marathon, not a sprint. Building wealth in crypto takes time and effort. Don't expect to get rich overnight. Instead, focus on building a solid foundation and gradually increasing your investments over time. Learn the rules, play smart, and you'll grow with this technology. As crypto continues to evolve and disrupt traditional industries, those who embrace it and adapt to its changes will be well positioned for success. You got this.